So before that, why don't you give a lot of this audience is much earlier in their journey. You've told the kind of the Dave story a bunch of times, but maybe just for everyone's perspective, what was the original impetus here? What did you originally start trying to do with Dave, and kind of walk us through what that looked like in those first kind of early year or two?
Well, just the founding of the company went back to a real personal pain point. The pain of going through high school, college, overdrafting your checking account, paying $34 on an overdraft fee up to $100 per day seemed incredibly painful, overly punitive for a college student that had somewhat regular income. The banks knew I was going to be good for the money, so why charge me so much? And after I sold my business from college, I had a little bit of a nest egg to want to go after a really big problem. And in 2015, 2016, this new company came out called Plaid, which was helping new fintech companies connect to consumers' checking accounts. The only company I really saw out there was a business called Acorns, which was using your cash flow data from Plaid to round up your small change into investment. And I thought, if I could have had this technology when I was in college and used that for short-term cash flow-based underwriting, the bank would have never had to charge me these crazy fees. Yeah. And so I want to build a JP Morgan competitor, but I'm not going to start with launching the whole checking account. I want to start with this short-term credit pain point. And so the first version of Dave was we literally built micro lending for America. You could download our product. You could borrow up to $75 was our credit limit to start, because we raised a very small seed round. You guys and Ryan was one of our very first investors. We didn't have a lot of capital to lend, so we started with a very, very small amount of money. And that amount of money was just the perfect amount I needed as a college student to cover a very short-term gap. And was just shocked at the receptivity of Americans for this small dollar product to cover their needs. And we knew we had something on our hands pretty immediately. And the fact that you could use our product, get access to liquidity within minutes of download, no credit check, no interest, no late fees, was really a game changer for user acquisition and for building a lot of word of mouth.
So where did those first customers come from?
Well, we found our first customer. Somebody searched in the App Store for overdraft. We didn't even know the app was live yet in the Android store. Someone downloaded the app. They got approved for, I think, $50. They paid us back on time, and they gave us a tip, which was our early business model, was to let people pay what they thought was fair for the service as opposed to charging mandatory fees. And we didn't really know what people's willingness to pay for the product would be, and so this optional fee model we thought was really novel and a great way to get started.
And why did you not stick with that? I guess maybe take a step back. How well did that model work in those early years?
It worked really well when we were very focused on these very small credit limits.
And what were these limits like?
$50.
Okay.
And literally micro lending. And as that business was taking off, we realized the customer demand was, hey, I still need a little bit more than that. So we started really building out our underwriting engine, mostly rules-based at this point, because this is pre-AI. So 2017, 2018, early 2019, we're still basically just putting rules in place. Do you get paid on a certain date? Do you have some liquidity post-paycheck to understand if the customer we think is actually good for the repayment, since we're not actually pulling any sort of FICO scores whatsoever. But the reality was, the larger we went up this limit curve, it's very natural. The larger you go up the limit curve, the less people are going to tip you on a percentage basis. And then people tend to not tip you over the lifetime of their retention on the product as well. It's very natural. People will give you a tip in their first few tries, and then, hey, I've kind of tipped Dave enough.
Right.
Thanks for the service. And we realized we sort of hit a wall of trying to get people the most amount of money they needed for their paycheck-to-paycheck liquidity needs. And so last year we rolled out a new fee model, which is mandatory, where you pay basically $5 for every 100 that you access. Still 80% cheaper than what you would get at an incumbent institution, and customers love it. Every customer gets the same fee. It's very consistent across the user base, and we saw, importantly, no impact to retention or conversion as a result of going to this new fee structure, and that resulted in a pretty significant business performance last year.
Yeah, I want to come back to that, but want to take a step back because thinking of that first fundraise, I know your Series A, you said something, you talked like 120 different VCs. What like that was a very different time. That was like what 2018, if I remember correctly, 2017 Series A.
The Series A would have been starting probably 2017.
Yeah.
We started those conversations.
And what was the challenge you ran into? Because the business was growing really fast.
Venture capitalists had never even heard of overdraft fees. There wasn't a problem they were used to dealing with, and it was an incredible uphill battle to convince them this was a problem worth solving. And so it was 120 meetings taken to get the Series A. The Series A investor we ended up getting didn't even really care about our product that much. It was a reference from one of our board members that said, hey, trust me, these are smart guys. Yeah. I'm telling you it's going to work. And they wrote us the whole check, and we only had one investor for the round.
And how big was the company who did that?
I'm not sure actually how much revenue we had.
No, but people-wise.
Oh, people. 25 people, maybe at that, 30 people at that point.
And then you did the Series B, I think about a year later, year and a half.
Yeah, Series B, so the Series A money really helped us just continue to develop our underwriting engine. The model really was taking, we didn't have enough money from our seed round, only $3 million to give out, because that was our balance sheet capital too, to lend effectively. We didn't have enough tape on our portfolio to go get a debt facility. And so we really were hamstrung for growth until we could get the Series A done to prove out a lot of the things we needed to prove. And post Series A, things really started to grow like a rocket ship. We had enough money to give out to customers. We could increase limits. We started to show this steep decline in loss rates as we made improvements in the models. And the next round we did was at $1 billion valuation a year later. So we went from $37 million was our Series A to $1 billion was the next round that we did. And the next round after that was going public. We only raised $60 million of venture capital dollars prior to going public. We didn't really want to be in the VC market anymore given their lack of receptivity to this hardworking American problem. And we thought the public markets were best suited for us. And so we went public earlier than we thought. And next January we'll have been a public company longer than we've been a private company.
Really?
And we're only an 8-year-old company. So, yeah.
That's remarkable. And it's interesting because I've actually, I think I've had Jason speak on a couple of different things. And in each case, like someone in the audience who's like working like the AV or like a caterer or helping out will be like, oh yeah, I love that product. That's great. And like we'll give him like feedback on like what's going on. So it's interesting that how many people are using it. What is the sense of the scale of people, like Dave users now?
Well, active users now, it's more than 1% of Americans are using the product on a monthly basis are active users. So you are going to get a lot of feedback from different people throughout the country, depending on where you are and what kind of situation you're in. But it's pretty amazing to be able to help people solve these short-term liquidity challenges. What keeps us motivated and going and excited to build better features and new products that also are going to cater to their needs to improve their financial lives.
So I want to take a step back because we talked about going public. And so you went public in early 2022.
Yep.
I think like January, it was still COVID. And then just the bottom of fintech dropped out.
Yep.
And the stock went down like 98,
yep.
9%.
It's a great memory.
It was, well, it's seared into it.
Yeah.
Yeah. And during that time, like, what were you thinking?
I mean, lots of thoughts. But look, we ultimately believed in our business. And so it really was a question, not like, hey, is this business going to work out? Because all the metrics were working in the right direction. Like we were growing like a weed. CAC was looking really good at that point. Underwriting was getting better. And so it was a truly dislocation in the market where people didn't understand that we were still going to be burning money until we could grow our way into profitability. The appetite for burning our way to profitability literally went to zero. And so the market fell out for every growth company, not just fintech. And we had two choices, stick in the public markets, keep burning capital, have a very clear script as to when we're going to actually achieve profitability, or take the company private, which would have been a headache in its own right. And Kyle and I, our CFO and COO, and I flew out to meet with Mark Cuban in person. We pitched him on this go private idea, and he's like, no, you should stay public. He's like, trust me, the short sellers in your stock are eventually going to have to buy the business. At some point, all short sellers have to purchase to cover, and you just need to prove them wrong. And once you achieve profitability, you own a lot of the company. Worst case scenario, you start issuing a lot of dividends or buying back stock. And we listened to him, we stuck it out, and it was this time in 2024 we came to present our Q4 earnings, our first profitable quarter, and the stock went up 80% in one day.
Yeah.
And it just continued to have great trajectory from that point forward.
But during that, and just so, when you went public, how many employees did you have, ish?
I think we had about 300 employees when we went public.
And the low point when it was like a $4 stock?
300. We never did a RIF. I mean, we never overhired. I think that's partly due to the fact we never raised a lot of venture capital either. So we never really could afford to overhire, but we never wanted to be a bloated team. And even today, we're still 300 people. 300.
And so I actually have a slide I made. And so this is like, I had Claude run all of the financial services companies in the United States, including all the banks, the top 200 banks, and their revenue per employee. And Dave actually has the highest revenue per employee. The next closest real bank is Goldman Sachs. And that dashed line there is JP Morgan.
Yep.
And you can see that, I mean, the company just generates a tremendous amount of revenue for each employee. And we spoke last summer, and kind of my hypothesis for you is like, is this AI? Because the business was generating revenue so much more quickly and so much more efficiently than it had in any previous time. And you kind of had like kind of. And I'd love you to kind of maybe reflect a little bit on like what role did AI, because you have, the cash AI.
Cash AI.
Feature. Like, how much of that is behind the efficiency of the organization here?
Well, first of all, the fact that we're doing cash flow-based underwriting, we're not relying on any FICOs or legacy models. We reinvented our own system with a very small amount of people. And we were the first in the market to pioneer cash flow-based underwriting for short-term credit. And then we're the first to pioneer marrying cash flow-based underwriting with artificial intelligence back in 2019. And that was a real game changer for us to just look at these billions of data points of our customers' transaction data to come up with commonalities of good and bad risks to make underwriting risk decisions. And the results have been going from roughly 5% default rate in 2019 to now we're about 1% default rate. And at the same time, we've grown originations multiple since going public. And even in the last year, we've grown originations per user, I think 50%, with loss rates going down significantly over time. And so we just don't need a ton of people to do that. I mean, these models are consistently being trained. We're adding new features. Our most recent Cash AI model has 200 more features than version 5.0. And we think there's still a lot of room to run to continue to make optimizations there to increase the amount of credit we can offer to our members. And importantly, we're also using the same Cash AI engine to develop new short-term credit products, like our forthcoming Pay in 4 product that we're excited about.
So I'm kind of curious, like, what do you think that means about like the state of lending and financial services in the U.S.? Because if you have these customers who, for the most part, are not, they're relatively low credit scores, is it safe to say, or kind of?
It's low, but that's by virtue of them being younger consumers. They might just be thin file. They might be new to the country. The reality is, we think that we're very disruptive anywhere where FICO is not the best suited product for Americans. And I view that to be in short duration credit, let's call it sub 120-day duration. We've really proven that FICO has no correlation to positive payback. And so cash flow data really is superior to that. We've proven it because our loss rates are so tremendous, and we've been able to increase originations per user. While you look at other categories of lending like auto loans or subprime credit card delinquencies are all trending in the wrong direction. The loss rates are going up, originations are going down, and we've seen literally the opposite effect.
Well, I guess what does that say about like the state of the American consumer, or like how we think about lending in this country? Because you're basically saying that these consumers are actually much better credit risks than the market is pricing them as, if you understand like their cash flow. It just makes sense. I mean, where's the dislocation? And as you think about growing the business and moving up for larger dollar amounts, say Pay in 4, at what point does your advantage, if it is an advantage, start to weaken?
I just think that some of the credit products built for Americans today are not in the best interest of American consumers. You think about subprime credit cards, they are optimizing for you being delinquent, right? They want you to make the smallest minimum payment so you can revolve on a balance, pay late fees, and pay compound interest. And that's not a great product for consumers. It's not a great product for investors either, because most of these credit card models end up getting blown up when you go through some cycle and you get caught with overextending a certain amount of money. And I think this consumer base that's subprime or sub $100,000 of income is better off with short duration credit, with very transparent cost structure, without the need to monetize and survive on late fees and compound interest. And that's where we think we're best suited to keep disrupting.
There's obviously, certainly in the last administration, very mixed signals on how this product should be treated from a regulatory standpoint. Obviously, I think it's a good product personally. I mean, certainly you do as well. But as you look out, where do you see the business having less regulatory risk now than it did before, or are you? Curious your thoughts on how you make sense of that, given kind of the lack of kind of really any regulatory oversight at this point.
I think that regulation overall is a good thing to protect consumers, but I think in many instances the regulators don't understand the problem that we're solving for customers and the problems that we're helping to save them from. And so, yes, we're going to continue to get questions from regulators over time. Fintech is never going to be immune to regulatory intervention, and just have to hope that Tom Brown helps all of us. That's the key.
Tom Brown is not a sponsor of this conference, what it's worth. So going to kind of the internal operations. So you're using AI for Cash AI. How is the rest of the team using it? I mean, to have that kind of growth, you obviously would expect to see it when customer service people roll out. You'd have more people working collections. You'd have assistants, and like how are you? Tyler asked this question last panel. Like, how are you using AI in how you manage the company, and how are people who report to you using it? Like, how do you see it kind of penetrating and accelerating Dave?
Well, it's actually one of our objectives of the company to make sure that the top 10 business use cases of the company all have AI intervene in the business. So everything from how we're analyzing the company to customer support, AI has to be embedded within the company to make sure we're getting the efficiencies. We just got a report today that over half our code is being written by AI at this point, and I think we still have a lot of room to go to make sure that's even higher. Me personally, I use it from every part of my life, from customer research to analytics on how our business is doing, to new product ideas, and even digging into new credit ideas and how it's going to survive in a regulatory structure and state licensing. It's just incredibly powerful tool to move faster and innovate more. And I think with the AI advancements in design and engineering, the ability to ship new products really is unprecedented.
Are you moving faster today than you were like a year ago or 2 years ago?
I think in fintech, you're always going to be bound by compliance and regulation. So there's always going to be speed bumps of how fast you can actually move. But I think getting from concept to design reviews, and ultimately establishing a business case for ideas, we're getting to those realizations faster. And then on the development side, I think we are getting there. But there's always the hurdles of regulatory, but also the benefit of the compliance and regulatory framework is it makes all of our businesses in fintech very tough to disrupt from a sort of vibe code AI development standpoint as well. You can't just sit there and go unlovable and create a version of Dave and launch it, right? It's just an incredible amount of overhead. You need the payments and infrastructure. You need the training data, the capital to go test, the bank partnerships. These things are hard to come by, and getting even higher barriers to entry as we continue to move forward.
When we spoke last summer, you talked a lot about how you want to kind of tell the story that Dave is really, it's a software company. It was not, if you think about the hierarchy of how you can value these firms, there'd be it's like a payday lender, which isn't worth much to maybe a short-term a lender to a software company. And you're really trying to tell the story that this is a software-driven business. It's AI at the center of it. I'm curious if there's obviously the SaaS apocalypse and the pretty significant retrenchment in the valuations of software companies. You have fintech companies now talking about how they touch money and therefore they're not just software anymore, and they've got some defensibility. Like, how are you thinking about that, or are you just kind of full steam ahead, or what do you think about is maximizing that kind of the market's valuation of your business?
I think our story is gravitating more and more to cash AI being the moat for our business, and the fact that we have issued 170 million micro credit transactions at this point, and that all that training data is used to reduce our loss rates, increase origination sizes, build new products. And we're very focused on that story being the defensible moat that we have, that our limits are the best, we have the best loss rates, and therefore our ability to use this technology to get into new products faster than competitors that are still reliant on sort of antiquated models or requiring direct deposit, and we don't need to be bound by those rules. I think we have a chance to really be a major beneficiary and AI winner in fintech.
Do you think you had had all those realizations if you had stayed private during 22, 23, 24?
Just a very competitive person, so I think that would have probably happened, whether we are private or public, but certainly being forced to get to profitability faster, I think we probably could have taken a little bit more time as a private company, but like being public has forced a lot of operational rigor in the company. It's not easy to be a public company, but it does just bring this level of, it just up levels the whole business and the whole management team to deliver on the quarter, but also think long term. And I think we become a much higher quality company from being public. And as I wrote to the company the week before going public, it might be a rocky road, not down 99%, but
it's slippery, like an avalanche.
Yeah. But ultimately I said, look, ignore the public market perception. Ultimately, the best companies are public companies. Yeah. Everyone goes public. And we're better off going out now, controlling our own destiny, and not having to go rely on Silicon Valley for capital.
You said something once we talked before that basically, like, because you had to kind of reissue everyone's options down at these low prices, that basically everyone at Dave did like extraordinarily well in like the.
They did, because ultimately when the market cap went that low, we couldn't actually pay people their stock options and regular restricted stock units. And so we had to get creative and issue performance stock units where, hey, you're going to get this measly stock package, but you're going to unlock more value at certain share prices. And it looked unreasonable at the time. Like people that were getting stock at $5 a share, I think some of them didn't actually get the full value of their package until it was like 20x the value. So it didn't even seem realistic.
Like $100.
But we made way more millionaires at the company post the turn down than we did when we actually went public.
Yeah.
And I think the people that stuck around were massively rewarded. And that's a pretty cool feeling both for us and for them that they stuck around and stuck with us. And surprisingly, and I owe this to being a very mission-driven company, is that we had such low churn, even after the company churned or went through that big of a downturn in valuation, which is probably one of my proudest moments as a leader of the business.
Yeah. Because it's interesting because obviously not to get too in the weeds of the cap table as a private company, but if you only had 20 odd people at the Series A, and how many people at the Series B, like 40, 50?
We had team size?
Yeah.
Yeah, that's right.
So the vast majority of the people were hired when the stock was at a pretty high private market price.
That's right.
Anyway.
Yeah, we did a lot of our hiring in sort of the lead up to the IPO.
Yeah. So you wonder how focused and those people got a lot more motivation kind of getting repriced. Like the alignment, the incentives got aligned a lot better as a public company.
That's right. I mean, the value you're going to see is very tangible once you achieve these results. And so everyone was very focused on delivering, but we never forgot about the customer. And I think because ultimately the business is not going to succeed without the customer doing well. And when you see user growth going up, when you see retention improving, that's really what led to the company achieving profitability. That's what the message is that we delivered to investors. It was a simple one, that once we reached 2.1 million paying members, every incremental user, because of our low headcount, is going to be, effectively pure profitability.
Yeah.
Or our gross margin is going to be effectively flow to the bottom line. And that turned out to be true. I think we burned $100 million in 2022. and we did 230 million of EBITDA in 2025. And that's a pretty insane turnaround in 3 years.
Yeah.
You know, just going from 2.1 million to we reported 2.9 million in Q4.
Was the rise up as shocking as well, probably not, but was it surprising as well how fast it turned around?
Well, just had so many people telling us it wasn't possible.
Yeah.
That our daily liquidity in our stock was too low, that there's like this terminology like a fallen angel. Like once you're a fallen angel, there's nothing that can be done. And it was pretty disheartening to hear that. But again, after going to Dallas to meet with Mark and hearing that story, I mean, he was right. He's like, look, you own a lot of the company. Worst case scenario, company makes $50 million a year and you're going to keep 20% of that. He's like, that's not the worst.
Yeah.
Not the worst place to be. And we listened to that advice and, you know, here we are.
Yeah. So where is business now? You've released earnings on Monday. Like,
Yeah.
give everyone a snapshot of like the scale of the business right now, kind of the goals for the year, like where you see it kind of going.
Yeah, so we did over 550 million of revenue in 25, grew 60% on the top line, which is, you know, pretty awesome for a business that's, you know, entering, you know, later stages here. Guided to do about 700 million of the midpoint in revenue for 26. And that's really just focused on building out our core business still. That's just really growing our debit card business and the extra cash product, which is our single pay credit solution. And then we'll launch this pay in 4 product this year as a test product for hopefully more scale in 27.
So where's the vision for the business in 10 years or 5 years?
I really think we have a right to play and win in this short-term credit category where, as I said, FICO is not well represented. And to me, that is in the pay in 4, kind of pay in 8 category where there's not a lot of great solutions out there that are direct to consumer. You know, subprime credit cards aren't great for customers. There's a lot of subprime installment loans that are short duration. They're incredibly expensive with huge late fees. These products should be disrupted by a company like Dave that has very low CAC and has much better next generation underwriting to just beat them on cost to serve, beat them on loss rate performance, and ultimately that's going to result in a better price for the consumer while we still have great margins. So it's going to be a great business for us. And I think over time, as we do more for our customers in short-term credit, the chance for us to win more direct deposit and deposit will grow over time, but it's not a major focal point of the business because we think that's not where we have the most level of differentiation.
Mm-hmm. How much, I guess, like, are there competitors in this space that you're worried about? Like, do you see other people who are really innovating to the degree that you all are?
We obviously pay close attention to some scaled competitors like the Cash Apps and the Chime of the world. We think of them as our closest peer competition, but like ultimately the amount of customers still banking at the large incumbents we view as the best place for us to go acquire customers from. And if we base our whole models off of Plaid so we can see where customers are coming from, and it's still the JPMs, the Bank of America is like, that's where customers are and have the biggest need. And the market's big enough for us, Cash App and Chime, to all grow our markets together, and we're still just all tiny from a total, you know, revenue, profitability, and user base than all those big guys.
So you have a room full of founders here. What is your, like, you must talk to founders all the time, like advice that you give them, share, like if you were like kind of through this experience, like anything you've learned where you're just like, this is kind of the advice I'd impart after this crazy journey.
Look, you got to be all in. That's really the best message. I mean, this can't be a side project for you if you're not feeling good about your business. You got to be in this for the long run. I mean, these companies take 10 years to work at a minimum, right? We're lucky that Dave is working this well after being in it for 9+ years, but you got to make sure it's an idea you really love, because I find the guys that sort of chase ideas, it's like a hot market idea or like a good way to jump in and raise funding, like that's just not going to be a great outcome. You have to have a passion for what you're building, because these things are really hard, and being the CEO and founder, you're everything from the janitor to the HR person to the CEO. It's like a really hard job, and so you better make sure you like what you're doing, and if you do, don't be discouraged by investors. Continue to keep your head down and build.
I think, yeah, there's probably not many founders who have been as discouraged by investors as you.
Yeah, we're pretty disgruntled.
They don't like your business, or they haven't in the past.
VCs, public market investors, like our business now.
Yeah,
Getting there.
is that a muscle you're learning now to communicate? Like,
It's a totally different world. Public versus private, it's incredibly different. Just the cadence of which you talk to investors, the types of things you prepare for investors, and how you think, it's just a totally different world.
what do you like more?
I like the public company life. I mean, a lot of people say it's not great being a public company CEO. Most people that say that are not public company CEOs. And so I think, I feel lucky to be in the seat. It's very rare to get into a public company CEO seat. I think it's really interesting, challenging work, and because of that, I find it interesting. And the short-term speed bumps of having to do earnings calls and deal with stuff you would maybe not to deal with as a private business, I don't know. Like I said, best companies, public companies.
Got a couple minutes for questions. Any questions for Jason? Oh, Luciana, you can.
Curious about what do you attribute? I think your CAC is incredible. Big fan of your CAC. Curious how you've been able to keep it so low, despite so many competitors entering the space. What do you attribute your ability to keep the CAC substantially low?
Well, we've really thought strong about brand from day one. I mean, we used a pretty big portion of our seed check to buy Dave.com. We had this bear mascot to try and really be differentiated and approachable versus these incumbent financial institutions. And then just the difference of how we thought about acquiring customers versus traditional neobanks or existing banks was starting with the access to short-term credit first, and then cross-selling people into a checking account was a better approach than trying to convince people to make Dave their primary checking account on day one. And so I think all those sort of three things combined has led to us having a very efficient CAC. Because ultimately that speed to value we can deliver on, when we have a marketing message out there that you can get money within minutes, and we deliver on that, a third of our customer acquisition comes from friends and family. And that's a big reason why we've been able to scale so well for so many years. Thanks.
Hi, Ravi Mickelson from Atmos Financial. Assuming you haven't only made the right decisions over these last 9 years, how have those decisions and corrections informed your decision-making process now?
Look, there's so many things to go back and try and course correct. And my partner in crime over here, our CFO, COO, we talked about all the different things we could have done differently, but at the end of the day, I don't think the outcome would be that different than where we are sitting today. And I think we're both happy sitting where we're at. Of course, everything from public company timing to getting this investor versus that investor, it's hard to say. Just no regrets.
You didn't make any mistakes.
No.
No big ones.
No. True.
I think I saw one more hand. We can play the time a second. Yeah. All right. Well, Jason, thank you so much.
Thanks a lot, Ryan.
I
appreciate it.
I really appreciate it.
Thanks.
You're awesome.
Thanks a lot. Yeah. Appreciate it, buddy.